Hello, everybody, and welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. This week, we have a lot to learn. It's going to be a big week learning-wise. We have a lot to watch out for. In particular, this week, we're going to look forward to a possible bear trap. We're going to see if some of the factors we've been looking at in ETFs, additionally, whether some of those factors, as they are expressed in Richard Newton's current ETF model, or ETF GameStop price correlation or forward predicting model, to what degree that remains forwardly predictive or valid, as well as, are we going to, if we do see something like that, are we going to see a continued respect of this 2x net asset value floor? Is that going to continue to be a lower bound, and to what extent we can expect maybe our current price action trend to continue to move higher? So we're thinking about that this week, and we've got a lot to look out for. I'm going to walk through some of the things I'm going to be looking out for, as well as some of our usual data telling us what we might be able to expect heading into today's trading and into trading this week as a whole. So let's get to it. But before we do, obviously, we have to start with our gratitude. And so thanks go out today to GME, sure, why not? Once again, feck it, be grand, for sponsoring today's article and video breakdown, as well as to our monthly contributors, Dat Scruffdo, Ken Wedmerlin, and Not Medical Advice, who help offset some of my data expenses on a regular basis. Many thanks go out to you, as well as to those of you who have supported in the past and will be supporting in the future. Thank you very much for helping me make this research and publication as available as possible. So So last Friday, for those of you potentially who did not have a chance to catch the live stream, we had a great group. We talked a lot about what some of the broader GameStop community has been pointing out to, as far as the servicing of this 2x GME leverage ETF put out by so it's T-Rex, but put out by Tuttle Capital Management. And we talked about little tinfoil, right? The fact that Roaring Kitty has some memes referring to this show, True Detective, right? Season 1, of course, the best season of True Detective, in which the big baddies, right? The behind-the-scenes baddies of this series are the Tuttle family. So this very well-connected family, right, that is kidnapping children, right, behind the scenes. Tuttle Capital Management, was this a nod to Tuttle Capital Management? Very interestingly, right, we've seen that these types of ETFs, Tuttle Capital Management specializes in the creation of ETFs, leverage ETFs, specifically with stocks that have a high degree of volatility, or recently, or in the near future, with respect to their creation, end up going through very high multiples of appreciation. What does that suggest then about GameStop? On the one hand, it does suggest that potentially GameStop has now been identified as a stock that is on the horizon for some potentially explosive growth. Many of us have known that for a while, or have understood that as a part of our fundamental thesis for why we are investing in GameStop. But of course, interesting to see the narrative and actions behind the scenes start to move into place as institutional finance, the big boys, the old guard, begins to reconfigure the board in order to finally permit something like this to occur. This, of course, being very interestingly the case insofar as Zacks has turned around and rated GameStop now as having potential for extremely dynamic growth. So interesting to see that take place. But of course, referencing this meme as we head into this week, referencing this idea of time being a flat circle, and thinking about what elements of our deeper price action cycles may still have yet to reveal themselves as we head into trading over the next few weeks. So, right, we're thinking about our last week, we talked a lot about the risk potentially of a downside correction, of something taking place over the course of maybe about a week to 7 trading days, and where that fits in our broader price action cycles. So you'll recall that we spoke at several points, right? I talked about this very often in our cycles, right? We have, number one, we have these price action cycles. Number two, they tend to be divided into two halves. One of them is a volatility phase and a price up phase. And then the second phase, the second half of this is a price down phase and a liquidity phase. So often we see the available liquidity on GameStop will contract, volatility will go up, and as it does, GameStop's price goes up with it. And then the other side, we see GameStop liquidity increase. And as we do, we see some of that lending liquidity, which is created for GameStop, being deployed in order to transpose the price back down. And in so doing, this is a volatility churning engine that helps options traders, especially to profit off of the movement of GameStop, to arbitrage these different pricing points, as well as legacy swap holders to successfully roll their positions while also being able to make up potential equity loss on those positions that they have been incurring for a sizable amount of time, right? So the longer they can kick the can down the road, the longer they can make money off of the volatility churn, the longer they can keep their swap positions open without needing to realize their losses on basically making a bad bet that GameStop would in fact be seller boxed, right? Something like that. So what are some of these potential factors? Okay, we have this proposition that potentially in the middle of these cycles, right? So if we scroll down, we'll take a look at some technicals here, easier to visualize, and we'll come back to some of our contextual factors here. So here we have GameStop's 4-hour chart, right? And we can see we have these episodes where we basically have a 1 to 2 week, not quite 2 week, sort of interlude in the midst of these two legs. So, right, of course, we have our price up and our volatility up phase here. We have volatility down and price down here. So this is, for example, taking a look at our last price cycle. And what we can see, right, is in the midst of these, we talked about this last week, right in the middle of it, about 5 weeks into each cycle, not coincidental, very likely has something to do with the T+35 settlement extension failed to deliver deadline. We see transposition and a moment in the middle of this cycle where we sort of flip back in the style of the inverse phase. So, for example, we have 5 weeks of volatility and price up, and then we have 1.5 weeks of moving down very sharply, liquidity up, and price down, only for then us to consolidate for about a week or so, and then begin about a 4-week move back to the upside before then we switch phases. Now, in the phase down, right, in the liquidity phase, the price down phase, after 5 weeks, what did we see again? We saw a return to high volatility conditions and a return to price levels that were indicative not of the price down phase, but of the price up phase. This lasted 1 week, and then we resumed our move down before then transitioning into this kind of strange annual earnings period. And now we seem to be entering into another volatility phase, but with something of a stymie here, right? We seem to be maybe already entering into this kind of consolidation phase. We do see our volatility moving down. Do we see a week come in where we see GameStop's price transposed to the downside, just like we saw, say, in this last particular phase? No two phases, of course, are the same. And of course, at different points in the year, we also have some different price cycles related to things like swaps or quarterly rebalancing, yearly rebalancing with respect to ETFs, a little hazier to try to track. But many factors, of course, will contribute to no two of these patterns in their particular instantiations looking exactly the same. So, but can we infer, will we get this kind of pause, maybe moving to the downside in the middle of our particular price up and volatility phase here? The first thing I suppose I'll say is that with respect to our deeper technicals, since we are here, I think I'll point this out. When I'm talking about a potential interlude in this phase, at no point am I suggesting that we're actually in danger of a major price down, that this phase need come to an end, with a major retrace to the downside, something like going back to $20 or $21. First off, that does not accurately, I would say, reflect the technical situation. I would say the fundamental situation of the company following the issuing of the senior convertible notes, these recent bonds, these 5-year 0.00 coupons for GameStop, right? So after these were entered into, after these bonds were, these arbitrage trade was built out, then this produced this opportunity for price up, which we've seen. Okay, a while back, right? So basically beginning of November, end of March, right? I spoke extensively about, and this was something I came to realize once I saw this price these price levels being approached was, how do we actually find a bottom? How do we find a fundamental valuation? What is actual fair market value for GameStop based on its fundamentals? And in the fall, I had noticed that this was very heavily correlated, even during our May to June price action, with what I refer to as our net asset value, which in the case of GameStop largely appears to be cash, right? If we assume basically a business valuation of zero, which seems to be the case, right? I mean, it does seem like the market is at this point assessing the value of GameStop's underlying business as essentially zero. It's not really a moneymaker. It doesn't appear to have particularly large growth. Now, we do see ourselves entering into a series of console cycles. The console cycle does indicate some elevated revenue. We do have, of course, Switch is coming out this year. Switch 2, I should say. Switch was the third best-selling console of all time. So Switch 2 maybe really may quite surprise with its very heavy numbers. I mean, within the first day or so, pre-orders sold out. So very, very good there. But by and large, up to this point, certainly for last year and up to our annual report, the business was essentially valued at zero. So GameStop's net asset value is largely calculated off of its cash on hand, at least until the company reveals that it has made some investments. That's cash, which is appreciating at the rate of treasuries, right, of bonds, standard government issue treasury bonds. So what seems to be the case is that cash has been evaluated something at like a 2x rate. Now, in my discussions with Richard Newton, especially, he suggested and hypothesized that the persistence of that valuation lets us know potentially what the effective short rate is. Okay, let's say if 100% of the company is shorted at this point, right, then that would elevate the valuation of that cash by 100% of the company's outstanding, something like that. So then that would elevate the floor of how the company would be valued to about 2x what their net assets value on hand. So back before we closed the bond offering, that was at around $21. That was slightly north of $21 based off of our earnings report. But with the $1.5 billion that was acquired, just under $1.5 billion in convertible bond via the convertible bond offering, this would put our theoretical 2x net asset value floor somewhere around $25 and like 20 cents or $25, and right with kind of the most conservative sort of estimate. We have something like Morningstar fair value around 23 something. And we have shown, I should say, if we go over to our daily chart here, this is our daily chart. Let's go back to our 4-hour chart. All right, we can see we've shown some remarkable stability in this kind of 2570 area, which historically we also showed as a support point right back here. But interesting to see that we are using the 54-hour moving average, continuing to use that just as we did in our previous price up phase as a technical moving support. So we have a number of these recurrent elements in this particular price up. But interestingly, right, does this then hold water? Does this then continue to serve as a supportive level based off of the understanding that, well, now we have this $6.3 billion in cash on hand, whether or not it's been invested in Bitcoin or not. If we have a consistency of that 2x NAV floor, and I mean, we had a ton of shorts enter just after earnings and the issuing of the convertible bond, right? So bond arbitrage traders, arbitrageurs entered into this trade. And so we have to assume that the net asset value, that 2x multiple, is at least consistent. So about, somewhere in the 25s, kind of mid to lower 25 seems reasonable. And of course, we have Morningstar saying that fair value is somewhere in the 23s. That's very good, right? That's very promising for finding something like a fundamental valuation of the company, even if you want to say that, say, 2750 or something like that is overvalued. There's not a lot of downside there, right? Okay, so particularly very good. We've also shown pretty decent divergence from the broader market. GameStop has proven to be basically market crash proof. So while everything was crashing, right, everybody was celebrating because GameStop was really sharply moving to the upside in this time period, right? So very interesting to see that. So I want to just reiterate that It is not my anticipation when I'm talking about a 1 week or a 5 to a 7 day downside correction that I'm talking about a collapse in the valuation of GameStop. That's not what I'm talking about. But with that in mind, this may prove, if we do get something like this, right, this is an interesting type of move that may provide opportunity for swing trades, for options, for especially given our implied volatility levels recently. If we are, and it does seem to suggest that we are in the context of continuing to move to the upside here. If we take a look at our fundamentals, this could provide, if we have an understanding, if we can anticipate this move to the downside, if it does occur, it can provide a very lucrative opportunity in order to build out or expand existing long trade positions or positions that would benefit off of an increase in implied volatility. So as we look at some of our momentum indicators, so relying here, of course, on Roaring Kitty's price momentum oscillator, we have some interesting momentum opportunities coming up. We continue to see the 55 PMO simple moving average move to the upside. It has been moving to the upside for several days now, basically since about early last week. In the next couple of weeks, I would venture to say potentially maybe 2 weeks, maximally about 3, we should get a zero line cross. This is a bullish indicator on our daily charts. Which, as we can see, when's the last time we had a zero line cross? Actually, the last time the PMO 55 did not come down on our daily chart. The last time we had one was actually when Roaring Kitty himself returned to X, right? So when he had his social media return was the last time that we had a PMO cross that significantly to the downside. So let's head over to TradingView. We can take a peek at this little live chart here. You can't quite see it too well there. We have our weekly here. Let's bump down to the daily, right? So you can see we have the opportunity, right? We've started to curl up. You can see these values here. So if you look in the bottom left corner of your screen, you can see, right? So right over here, you'll see where it says SMA 55 PMO. As I move my cursor over these values, you'll see that, right? Okay, we're moving down. Right, moving down in April, continuing to move down, 1.7, negative 1.87, negative 1.93, negative 1.97, negative 1.99, and then up we start moving, negative 1.98. This is on Tuesday. This is the 15th of April, right? Our shorter term indicators are already moving to the upside at this point when the 55 begins to move. In fact, they've already had zero line crosses of their own, which has corresponded to some pretty strong bullish price action. We go to negative 1.97 on the 16th. Negative 1.94, negative 1.91, negative 1.86, negative 1.8, negative 1.77, or excuse me, negative 1.72, negative 1.63, and that's where we were on Friday. So we're starting to move to the upside, and we're starting to move to the upside faster with respect to this indicator. We should open today, somewhere in the negative 1.5s. So that does presuppose that in about 14 days, 10 to 14 days, something like that, we should be seeing a zero line cross on the daily chart. And as we can see, the last time we had something like that was right here, right? I mean, GameStop was really moving pretty much below this. The 55 had just kind of crossed under this in March, right? It was kind of flattening out, was not really oscillating too much at all. But right, so just let's see. Right, so on our daily, basically around earnings in December of 2023, we had moved up pretty strongly. But then when we got that zero line cross, our shallower indicators had already started to correct down. So there wasn't really enough time for this to be bullish here. Not the case over here, right? Not the case here in May. Things went really wild, right? Things went really wild here. And we did actually continue to show a momentum move to the upside, even though these stayed suspended for a while. They started to correct, but so much momentum, they really stayed elevated for a while. And it's only once we got these uncrosses and then another cross here that we really started to move definitively to the downside. So definitely a bullish indicator for us to continue seeing our shallower moving averages continue to, go ahead and move to the upside. But a potential bullish cross coming up here with the 55. If we zoom out to our weekly chart, right, what can we see here? Well, another bullish indicator, we can see that our deep momentum is really still cruising to the upside. Slowed down a little bit with this price down phase here. But really heartening is we do see that our 20 PMO on the weekly chart is beginning to move back to the upside, beginning to appreciate once again after uncrossing the 55. So again, in another couple of weeks, we should see something of a bullish cross of the 35, the PMO 35, and then if we get a decent move by the end of May, it should somewhere in there start crossing. It's got a ways to go. It's got a ways to go. But if we really move up maybe into the 30s, we should over the next 3 to 4 weeks see a cross thereby, which will be a bullish indicator certainly. So that's very heartening, and I'm pointing that out because our broader context still says we're going to keep moving to the upside. We do have some continued momentum and stability there. But okay, again, this question, what about something of $1 or a $2 move to the downside? Do we see a little deflation? Do we see a little stutter? Do we see a little correction? Let's think about some of the contextual factors that might tell us or tip us off to whether that might be the case. Let's start out, as I start out the article, right, of course, looking at our broader context. Some pleasant surprises. I mean, we did call, right, been talking about this coming out of April OPEX. I said, okay, we're going to have this very large put gamma expiration. I would not be surprised to see something like we saw in March OPEX, which is a 5 to 7 trading day recovery period like we saw then, right? So we got a bullish recovery. Same thing. We've seen the same move. It's a lot more dynamic. It's a steeper recovery here coming out of May OPEX. We did have this bounce off of the 500-day or 100-week moving average, which was a very strong signal that we are going to reverse. We moved above the 20-day moving average, which was very good, even though we showed some resistance there when IBM was reporting earnings. Tesla and Google were decided ahead of time, I suppose, that they would be bullish. So we're still recovering. We do have kind of this proximal target here of the 50-day moving average at around 560. Above 550, if we take a look at our options gamma, we can see we have lower volatility conditions. We have larger long call positions on the parts of traders, and we are just starting to emerge out of this. If we can really get cruising kind of up into here, really that's kind of our target there, right? We can see 560. We can see that's our largest long call position in terms of net gamma exposure to our options market maker, or market makers, I should say. And yeah, that's going to be our near-term target. Of course, that's going to be a strong inflection point. That is our call wall. 88% of the time we do not get call wall breaches. So we are definitely leaning towards just statistically in terms of probability deflection off that level, especially since we do not have an evaporation of some of this fundamental underlying uncertainty, something that Spot Gamma, of course, in their daily newsletter, options forecasting newsletter, pointed out as well. We don't have a resolution of the tariff element. We don't have a resolution. Let's say we still have some uncertainty on the board this week in terms of earnings, as well as the Bank of Japan is going to be reporting its new interest rate, whether it will raise rates or not on Thursday of this week. So all of that can factor in to a correction to the downside. Though, again, I would say early in this week, right? So as we look right over here, oh no, this is not what we want. Yeah, no, this is what we want, right? So no, this is what we want. Here we go. Right, so as we can see, traders are still continuing to bet on a lower volatility environment. They're betting on long calls. They're betting on some stability basically into so day after BOJ, so this week, it's kind of even, but slightly bearish. May OPEX has softened a little bit in terms of how much of our total put gex is accumulated there. It's definitely a bit better. I would not say that we have strength to the bullish side, but we have this kind of tentative, maybe uncertain stability, at least in the very near future. Over the next couple of days. Again, while we have some more tech earnings reports coming up and the BOJ decision on Thursday, that could be a catalyst for, used as the excuse for a catalyst to move us back towards the downside and maybe realize a bit more of some of these put options there. So traders may see this as an opportunity to build out additional put positions heading into Bank of Japan, heading into this week's expiry, and heading into May OPEX. Again, we still have a lot of put gex accumulated at May OPEX. I would not be surprised if we saw some sort of move stimulated in order to realize some of that gamma exposure, so traders can profit. Bigger institutions that have these put positions built out can, realize some profit potentially off of these. Okay, what about GameStop though? What does that mean? Well, we have seen that there are periods of time where we do have some corrections to the downside that fall in line with the broader market. If we do see a larger correction that may be used as an excuse to bring GameStop to the downside, we may see some ETF outflows that depreciate the price of GameStop to a certain extent. Again, not catastrophically, but enough to justify the characterization of this price move as a downside correction, something of a retracement. Again, I would not anticipate that to go below the 2x cash floor, that kind of mid 25 area, but something for us, right? Always a chance, I suppose, something for us to keep an eye out for. Interesting to see how that can be evaluated, and that does more or less line up with that is an event that would occur this week and then basically fall in line with that 5 to 7 day sort of mid-phase correction type of activity. Okay, so that's possible. That's one contributing factor. Risk is certainly there for the broader market, but maybe perhaps not the strongest of risk factors for GameStop. So, okay, that's on the board. We do continue to see elevated price levels with respect to GameStop, successive closes over max pain. So, I mean, all of this continues to project stably. We did see the high probability scenario with respect to our options data that I spoke about on Friday. Namely, we just kind of, as we can see, right, we ping-ponged essentially between 27 and 28, closing right at about 27.50. So basically, yeah, we had a close on VWAP, very interestingly. Yeah, I mean, some good opportunities for day trades, but perhaps not the juiciest of moves to the upside. But nonetheless, in our deeper technicals, as we just saw for a moment down here, this did mean we're continuing to consolidate above some key moving averages. We like how this is looking, certainly over on the 4-hour, like how this is looking over on our daily chart, staying above the 100-day moving average. And then, yeah, very interestingly, also staying above the 20-day and the 20-week and 200-week simple moving average over on our weekly chart here. I will point out as well, right, we do have the sort of sequencing that imitates what we saw last sort of end of March. Right, I should say this is from December actually into April. So last 2023 in December, right, we had this kind of surprise earnings that were decent. We had this sort of cap on this formation, right? We were trading down, all of a sudden earnings came in, and we moved up to the downside, or excuse me, we moved up for a period of weeks and then corrected after the second week, right? Basically going into January, OPEX corrected down for a while, got a sort of full liquidity phase, and then again sort of came out of the hole following the rolling of swaps that were concentrated here. Same thing, now we're moving to the upside, right? We had 3 pretty strong weeks. Here we've got 2 really strong weeks, followed by 2 not as strong weeks, but still bullish weeks. Are we moving into a position to potentially exploit a more dynamic upside move here that coincides with one of these momentum crosses, these momentum indicator crosses? Something certainly in terms of similarity to keep in mind. Have that sketch there. You can check that out. Certainly, if you're new to the channel, you can always find my daily write-ups linked in the description of this video. They are accessible every day on my X account. So do be sure to check that out if you want a deeper dive, a written, more structured deeper dive, different than my sort of walkthrough here over on X. Yeah, so certainly technically things looking good, not really looking like from a technical perspective there's much risk to the downside. The one element I would say that does sort of suggest that we might be in store for something of a short-term correction is somewhat uncharacteristically, we do see that GameStop liquidity levels are very high. They're very close to 52-week highs. If we take a look right now, we're back up over 4 million shares. In fact, if we bump over here just before market open, I think we're back in the 4.1. We've been kind of dancing around 4.14 million shares here. XRT did have was starting to correct, with which I should say was starting to go through a number of creation orders. Creation orders typically correspond to ETF-induced bullish price action over in GameStop. So as creation orders come in, supposedly this does correspond to the ETF having to go out and get shares. Of course, they can fail to deliver that, or when they build the new ETF share via creation orders, they can supply cash in lieu of security, so they don't have to do that. But typically, when you see creation orders come in, that's more or less a bullish signal for GameStop, except in the event that there are not, I guess, trailing FTDs, something like that. So we still see XRT is doing this kind of strange liquidity charade thing where the shares available to borrow go down very sharply at around between 7:15 and 7:30 a.m. Outstanding did start to go up. We saw some creation orders, but then it came back down. Right, so it had come very low just prior, basically at the end of just around Easter, right over the weekend, and then into the early part of last week. Started to move back up again, came back down again on Friday, almost 1 million shares redeemed. So this excess liquidity does not typically align with what we're used to seeing in these volatility price up phases. This is a lot of GME lending liquidity, and typically an excess of GME lending liquidity corresponds to lower implied volatility rates, and therefore does not typically correspond to price up. So this is something of an anomaly. This is something of an aberration. If we do take a look at our implied volatility levels, we see that reflected. We see that reflected in our 10-day mean volatility. It has largely been trending down for the better part, really for all of April, and even the last couple of days of March there. We can see that if we go over to our Schwab composite implied volatility, we had seen a heightened Volga period. That is a heightened period of a rate of change of IV, but that is also flattening out and looking something like a liquidity phase, something to keep in mind. And if we go ahead and we look at our options implied volatility across individual weeks, we can see that very curiously, implied volatility for May is very low. Not excessively low, but it's low for this this period, right? In price up phases, in these volatility phases, we don't typically see week after week after week of low IV per expiry. So we're usually used to seeing something in like the 90s or the hundreds more approximately, and we're seeing sort of mid to upper 70s here. Sometimes during the day, some of these will shoot down into the 60s. So that's pretty low. What does that mean? Does that mean that the some form of consolidation is expected over the next couple of weeks? Does that mean that this is in general maybe preparation for volatility several weeks or months out following following May? We can see that June IV is up, right? June IV is close to 100%. That's on the higher side. That's certainly not probably a midpoint as far as GME goes. Like GME IV can get pretty high, but that's right. That's very high. That's very high. And then unusually, right, July as well at 92%, and then it goes down a bit, and then we're back to October, Jan, December. We're a lot more like what we are now. But very interesting to see that. So this basically says options are being priced at a discount over the next few weeks, basically into the end of May, and then they're being priced at a premium heading into June and July. So what exactly does that mean? Is that preparation? Is that an attempt to price options lower in order to incentivize purchases in the near term, in perhaps anticipation of something more volatile coming up in the weeks to come? Maybe it is preparation for a type of move that then is expected to occur in June and July. Won't speculate too heavily on this, but interesting to see this dynamic at play. And then, of course, right, what I'm looking at, what Richard Newton has been hard at work on, has been taking his very, very meticulously collected ETF data. So definitely would recommend, if you do not already follow his channel, I'd really recommend that you do that, as well as take a look at some of his collected data on his publicly shared ETF spreadsheet. That's more than just ETF spreadsheet. It's quite a lot of data, but that's a really the ETF data is a front and center of this data collection. So I'd highly recommend you check that out. But he has developed a new model which is based on a combination of this cash on hand pricing model as a floor, combined with ETF flows, and of course the recent introduction of this arbitrage trade. So he talks about this on a regular basis. I'd really recommend that you go ahead and take a look at his channel. This all credit, right, goes to him for putting this together. But as we can see, right, if indeed this model, and it has some recently had some pretty excellent correlation to our price action recently, it does project that basically after today, we can anticipate a move down. We can anticipate something, something of a correction. If the precision of the pricing is to be expected, somewhere into maybe somewhere around Morningstar fair value, right? Somewhere just north of that in kind of the 24s, maybe as an absolute low kind of there. Our options data does not necessarily suggest that, but of course, right, this ETF shenanigans shorting can very quickly change how our options are behaving, right? Options exert a kind of force on our price action. They give us a kind of structure that greatly affects our intraday movement and our day-to-day and our week-to-week movement, under the assumption that there are not large externalities that kind of, stick their hand in the machine and then gum up the works, right? Put their finger in the whirlpool is like the metaphor that I've used to describe this. So his model does project that we have something of a mid-range correction, interestingly, based on these ETF creation and redemption activity. So very interesting to see that. I'll be very interested to see whether indeed we do get that type of correction heading into basically the next week. It's only going to last about 5 to 7 days, right? So which is just the length of time that we've typically seen after 5 weeks in one of our volatility price up cycles. We usually see that, right? We see this 5 to 7 trading day mid-range correction to the inverse of the direction of the trend. So in the price up phase, that's a transposition down. In the price down phase, that's a return very, very dynamically to the upside. So what are we going to be looking at here? Is this ETF model will it be able to give us that kind of prediction heading into the next 5 to 7 days? And then, of course, coming out of that, right? So something to observe, something to keep our eye on, something to potentially add a little bit of caution in the immediate term. But yeah, options wise, we are still looking stable, slightly skewed bullish toward the end of last week. We do see some new put positions developing, but these are trader short positions from the looks of it, based on the sentiment of the purchases. So these are at 23 and 26. These are trades where the trader has gone ahead and sold puts. So these are not bearish bets. We do have a lot of our call OI rolled basically at $27 and up. So traders last week were not particularly interested in anything having to do with our call strikes below $27. Our OI is very light in general below $27. So you can see that trader focus, right, the focus and price action for traders is still in this kind of tight $27 to $30 box. This is where options traders are looking right now. So that certainly forward projects a bit of stability, even if that's mostly something that is indicative of the options market as a whole. Max pain is at 26. Again, that continues to project that we're going to be closing at some of these these elevated price levels. And our gamma exposure largely looks like what we saw last week. Of course, we have some of this put OI that's extended, but of course, as we know, at 23 here, this is trader short. And at 26 here, this is also a trader short position. So this is a little bit more stable or hedging supported than we would, market maker hedging supported, I should say, than would otherwise be anticipated by those levels of put gamma exposure. So yeah, it really looks like we're going to be trading once again, right, kind of in this 27 to 29.50 area, with basically 29.50 as our maximal extension on the week. Keeping an eye out on whether we're going to get something of this correction, whether that's going to be associated with a corresponding move in the broader market is an open question. Of course, heading into what Bank of Japan will decide and whatever supposedly tariffs have in store for us, whether we get a reprieve from some of that uncertainty or not. So that's what I'm watching out for. Very interested to see, of course, how Richard Newton's very recent model holds up, whether that can in fact be another tool that we can put into our belt, and of course what that tells us, right? The implications of that insofar as our ETF creation and redemption is concerned in relation to some of our other key metrics on GameStop. So going to be a very interesting week for a number of reasons. At the sort of not leastly for the potential epistemic value of what we might discover. So very, very exciting, very much looking forward to this week, very much looking forward to a continuation of some of these these uptrends that we've seen, this deeper uptrend that we've had the privilege of enjoying over the past month or so. So yeah, good luck with your trades out there. Thank you as always for your comments, for engaging. Thanks as always to everybody for for dropping by the live stream last Friday. Look forward to seeing you all, of course, every day this week with these video updates, and of course with this week's live stream at 4 p.m. Eastern time. So thanks very much, everyone. We will see you tomorrow. Take care.